Before we begin, please remember that I am not a financial advisor, mortgage lender, or real estate professional. This presentation is for informational and educational purposes only. The information provided is not intended to be a substitute for professional financial advice. Always consult with a qualified and licensed professional before making any major financial decisions, especially one as significant as purchasing a home. Your personal financial situation is unique, and the steps you take should be tailored to your specific circumstances. 1 out of every 10 mortgage applications in America gets denied. 1 in 10. Now that might not sound like a lot until it's you. Until you're the one who spent months scrolling Zillow, saving every penny for a down payment, and finally finding that perfect house, the one with the big backyard for the dog, and the kitchen that gets the morning sun just right. You can already picture your life there. You submit your application filled with hope and anxiety, and you wait. And then you get the email. A cold, one-sentence rejection that shatters that entire dream into a million pieces. All that work, all that hope gone. Why? Because of a number on a form you didn't understand, or a mistake you made 6 months ago that you didn't even know mattered. That soul-crushing experience is what this video series is designed to prevent. This is not going to be another boring lecture filled with confusing jargon like DTI, LTV, and ARM. This is your playbook. This is the definitive step-by-step guide to navigating the entire U.S. mortgage approval process from start to finish, built for beginners. We are going to pull back the curtain and show you exactly what the banks are looking for, what they're scared of, and how to build a financial profile so strong that they'll be competing for your business. By the end of this series, you won't just understand the process. You will master it. You will walk into that lender's office with the confidence of an insider, ready to secure the keys to your future home. So let's get started. The single biggest mistake people make when buying a house is thinking the mortgage is the last step. They find the house first, fall in love, and then scramble to get the money. That is completely backward, and it's the fastest way to get that rejection letter we just talked about. You have to flip the script. Getting the mortgage isn't the last step. It's the first. Before you even open a real estate app, before you call an agent, before you daydream about paint colors, you need to become what lenders call approvable. Think of it this way. You are the CEO of a brand new company called Project Buy My House. Your job as CEO is to prepare a business plan and pitch it to investors. In this case, the investors are the mortgage lenders, and the business plan is your financial life. They are not going to invest hundreds of thousands of dollars in you based on a whim. They need to see a rock-solid plan that proves you are a safe, reliable, and profitable investment. And what does that business plan look like? It all comes down to what I call the lender's trinity. These are the 3 pillars that every single mortgage decision in the United States rests on. They are your credit, your income, and your assets. That's it. Every form you fill out, every document you provide, every question they ask is designed to test the strength of these 3 pillars. Your entire mission starting today is to make each of these pillars as strong and stable as humanly possible. In this video, we're going to tackle the absolute foundation of your entire application, your credit. Your credit score is not just a 3-digit number. It's a grade on your financial trustworthiness. It's a summary of your entire history of borrowing and repaying money. To a lender, a high credit score screams, this person pays their bills on time every time. They are responsible. They are a safe bet. A low score, on the other hand, flashes a giant red warning sign that says, high risk. Proceed with caution. Before they even look at how much money you make, they look at how you've handled money in the past. This is non-negotiable. You could be a millionaire, but with a 520 credit score, you're going to have a brutal time getting a good mortgage if you can get one at all. So, what is your credit score actually made of? It's calculated using a secret recipe, but the main ingredients are public knowledge. The single most important ingredient, making up about 35% of your score, is your payment history. This is the king. Do you pay your bills on time? Every time. A single 30-day late payment can devastate your score and stay on your report for 7 years. This is why the first thing you must do right now is set up automatic payments for every single bill you have: credit cards, car loans, student loans, everything. No exceptions. The second most important ingredient, worth about 30% of your score, is called credit utilization. This is the queen. It's a fancy term for a simple idea. How much of your available credit are you using? Let's say you have one credit card with a $10,000 limit. If you have a $5,000 balance on it, your utilization is 50%. To lenders, a high utilization ratio suggests you might be overextended and relying too much on debt to live. You'll hear a lot of so-called gurus talk about the 30% rule, meaning you should keep your utilization below 30%. That's okay advice, but if you want to get the best mortgage rates, you need to be an A+ student, not a C student. The real magic number is under 10%. People with the highest credit scores, the 800+ club, consistently keep their credit utilization in the single digits. This shows lenders you have access to credit, but don't need to use it. It's a massive power move. A quick hack to manage this. Your credit card company usually reports your balance to the credit bureaus on your statement closing date. It doesn't matter if you pay the bill in full a week later. They report the balance on that specific day. So, if you want your utilization to look incredibly low, make a payment before the statement date to knock the balance down. The other factors are your length of credit history, which is about 15% of your score. This is why you should never close your oldest credit card, even if you don't use it. Just buy a pack of gum with it every 6 months to keep it active. A long history shows stability. Then there's your credit mix, about 10% of your score. Lenders like to see that you can responsibly handle different types of debt, like a credit card, revolving credit, and a car loan, an installment loan. Finally, there's new credit, also about 10%. This is why you should absolutely not go out and apply for a new store credit card or a new car loan in the year leading up to your mortgage application. Every time you apply, it creates a hard inquiry on your report, which can temporarily dip your score and make lenders nervous that you're about to take on a bunch of new debt. Okay, so what are your action items? Your first mission is to get a clear, honest picture of where you stand. Don't just rely on the free scores from apps like Credit Karma. Those are typically Vantage scores, which are great for monitoring, but almost all mortgage lenders use a FICO score model. They can be different. You are legally entitled to a free copy of your full credit report from all 3 major bureaus, Equifax, Experian, and TransUnion, once a year from annualcreditreport.com. Get it? Read through every single line. Are there any errors? Any late payments you don't recognize? Dispute them immediately. Second, find out your real FICO score. Many credit card companies like Discover, American Express, and Bank of America now offer a free FICO score as a perk to their customers. Check your online dashboard. This is the number that truly matters. Third, analyze your credit utilization. If it's over 10%, your primary financial goal for the next few months is to aggressively pay down those balances. This is often the fastest way to see a significant jump in your score. Forget saving for a bigger down payment for a moment. Every extra dollar you have should go toward crushing that credit card debt. A higher credit score will save you tens of thousands of dollars over the life of your loan, far more than a slightly larger down payment will. By focusing on these foundational steps, perfecting your payment history, crushing your credit utilization, and cleaning up your report, you are building the unshakable first pillar of the lender's trinity. You're not just hoping for an approval. You're building a case that is too compelling for them to deny. You are taking control. And in our next part, we're going to fortify the second, and arguably most scrutinized pillar, your income. We'll break down exactly how lenders calculate what you can really afford, and how to document every penny of your earnings to maximize your borrowing power. When a lender looks at your income, they aren't just seeing a number. They're reading a story. And the story they want to read is one of stability, consistency, and reliability. Your salary might be $100,000 a year, but if you just started that job last week after being unemployed for 6 months, an underwriter sees a question mark, not a number. The first rule of income verification is this. It's not about what you make. It's about what you can prove you've been making consistently over time. For lenders, the gold standard is a 2-year history. They want to look back over the last 24 months and see a clear, uninterrupted pattern of earnings. This gives them confidence that your income isn't a temporary fluke, but a reliable stream of cash that will continue long after they hand you the keys to your new home. Now, this doesn't mean you have to be at the same exact job for 2 years. People get promotions, they change companies for better opportunities, lenders get that. A job change can actually be a positive thing if it shows upward mobility in the same field. Moving from a staff accountant role at one firm to a senior accountant at another with a 20% pay raise? That's a great story. It shows career progression. But switching from being a salaried nurse to a 100% commission-based real estate agent a month before you apply for a mortgage? That's a much harder story to tell, because you've traded a predictable income for a variable one with no track record. The key is demonstrating that your career path is stable, even if the company name on your pay stub has changed. So how do you prove this story? With a mountain of paperwork. Let's start with the simplest scenario, the W-2 employee. If you receive a regular paycheck from an employer, you are the underwriter's favorite person. Your income is straightforward to document. You'll typically need to provide your most recent pay stubs covering a 30-day period, your W-2 forms from the last 2 years, and sometimes your federal tax returns for the last 2 years. Why all the redundancy? The pay stubs show your current rate of pay and year-to-date earnings. The W-2s confirm your total earnings for the previous years. And the tax returns? They act as a final verification, ensuring that what you're reporting to the lender matches what you're reporting to the IRS. They also reveal other potential sources of income or loss that might not show up on a pay stub. But what if you're one of the millions of Americans who are self-employed, a freelancer, a gig worker, or a small business owner? This is where the process gets significantly more complex. You don't have a W-2 or a steady paycheck to prove your earnings. Your proof is your tax return. For you, the last 2 years of full federal tax returns, including all schedules, especially Schedule C for sole proprietors or K-1s for partnerships, are not just a suggestion. They are the absolute foundation of your application. Here's the crucial part that trips up so many self-employed borrowers. The lender is not looking at your gross revenue. They are looking at your net income after all your business expenses have been deducted. That brand new laptop you wrote off? The home office deduction? The mileage? Every single dollar you deducted to lower your tax bill also lowers the income you can use to qualify for a mortgage. Lenders will typically take the net income from your last 2 tax returns, add them together, and divide by 24 to get your average monthly qualifying income. And here's the kicker. If your income in the most recent year was lower than the previous year, they will almost always use the lower, more recent number. They want to see stable or increasing income. A downward trend is a major red flag. You'll also likely need to provide a year-to-date profit and loss statement, or P&L, and a balance sheet for your business to show that your current year's performance is on track with previous years. The lesson here is profound. For at least 2 years leading up to your home purchase, you have to balance the desire to minimize your tax burden with the need to maximize your qualifying income. Now let's talk about the other types of income that can get layered on top of your base salary or self-employment earnings. Things like bonuses, overtime, and commissions. You might have received a huge, life-changing bonus last December, but you can't just waltz into a bank and expect them to count it. Remember the rule: stability and consistency. To use this type of variable income, you almost always need a 2-year history of receiving it. The lender will average it out over 24 months to get a predictable monthly figure. If you got a $12,000 bonus last year and a $12,000 bonus the year before, the lender will add $1,000 per month to your qualifying income. But if you got a $24,000 bonus last year and $0 the year before, they might still average it to $1,000 a month, or they might be more conservative, questioning its likelihood to continue. This likelihood of continuance is the third pillar of income analysis. The lender needs to be confident that the income will continue for at least the next 3 years. This applies to everything. Part-time job income? You'll need a 2-year history to show it's not a temporary gig. Alimony or child support? This can absolutely be used as qualifying income, but you'll need a copy of the divorce decree or court order stating the amount and duration, and you'll need to provide bank statements proving you've been receiving it consistently for at least the last 6 to 12 months. The order must also show that payments are set to continue for at least 3 years from the date of your loan closing. The same logic applies to Social Security, disability, or pension income. You'll need the award letter and proof of receipt. All of this documentation, all of this history, all of this verification is done for one single purpose: to calculate one of the most important numbers in your entire financial life, your debt-to-income ratio, or DTI. DTI is the metric that ties everything together. It's a simple percentage that expresses how much of your gross monthly income is eaten up by your monthly debt payments. It's the lender's primary tool for measuring your ability to handle your existing debts plus a new mortgage payment. There are 2 parts to it. The first is the front-end ratio, which is just your future total housing payment. That's principal, interest, taxes, and insurance, often called PITI, divided by your gross monthly income. But the one they really care about is the back-end ratio. This is your total proposed housing payment plus all your other monthly debt obligations, car payments, student loans, minimum credit card payments, personal loans, all of it, divided by that same gross monthly income. Let's walk through a quick example. Let's say, after analyzing your pay stubs and W-2s, The lender determines your qualifying gross monthly income is $7,000. Your proposed new mortgage payment, including taxes and insurance, is $2,200. You also have a $400 car payment and $300 in student loan payments. Your front-end DTI would be your housing payment, $2,200, divided by your income, $7,000, which is about 31%. Your back-end DTI would be your total debt, $2,200 for the house plus $400 for the car plus $300 for student loans equals $2,900, divided by your income, $7,000, which comes out to about 41%. That 41% is the number the underwriter will focus on. Generally, for a conventional loan, lenders want to see a back-end DTI of 43% or less. Some programs allow for higher DTIs, sometimes up to 50%, but that often requires compensating factors like a massive down payment or pristine credit. This ratio is the ultimate gatekeeper. Your income might be fantastic, but if your existing debt obligations are too high, your DTI will be out of whack, and the door to approval will slam shut. This is why understanding how your income is actually calculated by a lender is so critical. Every dollar of verifiable, stable income you can prove pushes your DTI lower and dramatically increases your purchasing power. But even with the rock-solid six-figure income documented perfectly, there's a silent killer that can completely derail your mortgage application. It's the other half of that critical ratio, your debt. In the next part, we're going to dissect every liability on your record, from student loans to that forgotten store credit card, and show you how to manage them to get the green light from the underwriter. So let's pull back the curtain. When a mortgage underwriter looks at your financial life, they don't see debt the way you do. You see a mountain, that total terrifying number you owe on your car, your student loans, your credit cards. Feels immense, maybe even impossible. But the underwriter, they see something different. They're not looking at the mountain. They're looking at the shovel you're using to chip away at it each month. They care about one thing above all else: your minimum monthly payments. This is the single most misunderstood concept in mortgage lending, and getting it right is the key to unlocking a better loan. Your total debt could be $200,000, but if your required monthly payments are low, you're in a much better position than someone with only $20,000 in debt, but sky-high monthly payments. It's all about cash flow. The lender is asking, after this person pays all their mandatory monthly bills, how much is left over to comfortably pay us for the next 30 years? Let's break down exactly what they're counting. It falls into a few main categories. First, you have installment loans. These are the predictable ones. Your car loan, a personal loan, a furniture loan. The payment is the same every single month for a set period. If your car payment is $500 a month, the lender writes down $500 on their worksheet. Simple. Then you have revolving debt. This is where it gets tricky. We're talking about credit cards, home equity lines of credit, or any credit line you can borrow from, pay back, and borrow from again. Here, the lender typically takes the minimum payment listed on your most recent credit card statement. But what if you have a 0% introductory offer and the minimum payment is tiny, like only $10? Don't celebrate just yet. Many lenders have a rule. If the minimum payment is very low, they will instead calculate a payment for you, usually by taking a percentage of the total balance. A common figure is 1%. So, if you have a $10,000 balance on a card, even with a tiny minimum payment, the lender might hit your DTI ratio with a $100 monthly payment. This is a silent killer of mortgage applications. You think you're fine, but the lender's internal math tells a different story. And then there are the obligatory payments that aren't technically loans. Alimony, child support, separate maintenance. These are counted dollar for dollar against your income. If you pay $1,000 a month in child support, your borrowing power is reduced as if you had a $1,000 car payment. It's a non-negotiable part of the calculation. Now let's talk about the ghosts in your financial closet. The debts you've completely forgotten about. That Best Buy card you opened 3 years ago to save 10% on a TV and never used again? If it has a balance, it counts. That PayPal credit account you used once? It counts. And the new players on the block. The buy now, pay later services like Affirm, Klarna, or Afterpay. For years, these were the wild west of credit, often not reporting to the bureaus. That's over. Lenders are now seeing these show up on credit reports, and they are absolutely counting those small recurring payments in your DTI. That $100 payment you're making every month for a new mattress? It just reduced the amount of house you can afford. You have to be a detective and hunt down every single monthly obligation, no matter how small. But there is one category of debt that causes more confusion, more frustration, and more denials than all the others combined: student loans. This is the great white whale of modern mortgage lending. Because of the dozens of different repayment plans, deferments, and forbearances, a universal rule was needed, and that rule can be brutal. If you are on a standard repayment plan where your payment fully amortizes the loan, the lender will just use that payment. Easy enough. But what if you're on an income-based repayment plan, or IBR? What if your payment is currently $0? Or you're in deferment while you're back in school? You might think, great, my payment is 0, so it won't affect my DTI. That is a catastrophic mistake. Lenders know that $0 payment isn't permanent, so they create a phantom payment for qualification purposes. The most common rule for conventional loans is that the lender will use 0.5%, 0.5%, of your total outstanding student loan balance as your monthly payment. Let's run the numbers on that, because this is where dreams of homeownership can evaporate. Imagine you're a teacher with $80,000 in student loans. You're on a plan where your payment is currently 0. You think you're in the clear. But the mortgage underwriter takes $80,000 and multiplies it by 0.5%. That creates a $400 monthly debt payment out of thin air. A $400 payment that is now factored into your DTI. That single calculation could reduce your borrowing power by $60,000, $70,000, or even $80,000. You go from being approved for your dream home to being approved for a small condo, all because of a phantom payment on a loan you're not even paying yet. For FHA loans, the rule can be even stricter, sometimes using a full 1%. That same $80,000 loan balance now becomes an $800 monthly payment. It's devastating. So what do? We can't just wish the debt away. We have to get strategic. This isn't about just paying off debt. It's about surgically reducing your monthly obligations to satisfy the underwriter's formula. Your goal in the 6 to 12 months before you apply for a mortgage is not necessarily to pay off the most expensive debt or the biggest debt. Your goal is to eliminate the highest monthly payments relative to their total balance. Think about it this way. Let's say you have $5,000 in savings you can use to pay down debt. You have two options. Option A is a $20,000 car loan with a $400 monthly payment. Option B is a $5,000 personal loan with a $300 monthly payment. Most people would throw the $5,000 at the car loan. It's the bigger, scarier debt. But from a mortgage qualification standpoint, that's the wrong move. Paying $5,000 on the car loan might only reduce the payment by a little, or not at all if it's just an extra payment. But using that same $5,000 to completely wipe out the personal loan, you have just instantly freed up $300 in monthly cash flow. You've eliminated a payment entirely. To an underwriter, you just gave yourself a massive raise, increasing your borrowing power by $50,000 or $60,000 overnight. You need to line up all of your debts, not by interest rate, not by total balance, but by the DTI impact. Look for the low-hanging fruit. That $400 furniture loan with only $2,000 left to pay? Get rid of it. That store credit card with the $200 balance but a $50 minimum payment? It's a tiny debt, but it carries the DTI weight of a $10,000 car loan under the 0.5% rule. Pay it off. This is a game of inches, and every single monthly payment you can eliminate is a huge win. And while you're strategically paying things down, you also have to play defense. The period before you apply for a mortgage is a financial lockdown. Do not, under any circumstances, take on new debt. Don't go buy a new car, no matter how tempting the offer is. That new $600 car payment is the #1 killer of pre-approvals. Do not co-sign a loan for anyone. Not for your brother, your cousin, your best friend. The moment you co-sign, that entire debt payment is treated as yours, even if you never make a single payment. The lender doesn't care who is actually paying the bill. If your name is on the loan, it's on your DTI worksheet. And finally, be very careful how you pay things off. If you're going to pay off a big loan, don't do it with a pile of cash you've been saving under your mattress. Lenders need to source all large deposits and movements of money. The funds used to pay off debts need to come from a legitimate, documented source, like your checking or savings account. Mastering your liabilities is about understanding the lender's perspective. It's not about being debt-free. It's about having the lowest possible monthly obligations on paper. By dissecting your debts, hunting down the silent DTI killers, and strategically eliminating payments, you transform yourself from a risky applicant into an ideal borrower. We've now meticulously engineered our income and our debts, building the strongest possible foundation for our DTI ratio. But there's a 3-digit number that governs this entire process. A score that can either unlock the door to your dream home or slam it shut in your face. It's your credit score. And in the next part, we're going to demystify this number, revealing the secret hacks lenders wish you knew to boost your score fast, and expose the common myths that are costing you thousands. Think of your credit score not as a number, but as your financial reputation. It's a 3-digit story that tells lenders everything they need to know about your reliability, your discipline, and your trustworthiness with money. Before a lender even looks at your income or your down payment, they look at this score. It's the silent judge that decides if you get the best interest rate, a mediocre one, or no loan at all. Get this part wrong, and you could be throwing away over $100,000 in extra interest payments over the life of your loan. Get it right and you unlock the keys to the kingdom. So what is this magical number, really? It's primarily based on a model created by a company called FICO, and it's calculated from the information in your credit reports, which are held by 3 main bureaus: Equifax, Experian, and TransUnion. And this FICO score is made up of 5 key ingredients, each with a different weight. Understanding these is the first step to mastering the game. First, and most important, making up 35% of your score, is your payment history. Think of this as your financial handshake. Is it firm and reliable or weak and forgettable? It's a simple record of whether you've paid your past credit accounts on time. A single late payment can be a scarlet letter on your report for up to 7 years. So this is non-negotiable. Pay every bill on time every single time. That's the foundation. Second, at 30% is amounts owed, or what insiders call your credit utilization ratio. This is a huge one and where most people get tripped up. It's the amount of credit you're using compared to the total amount of credit you have available. Let's say you have one credit card with a $10,000 limit, and you have a $3,000 balance on it. Your utilization is 30%. Lenders see high utilization, anything over 30%, as a red flag. It suggests you're overextended and might be a risk. The secret here? Keep your utilization as low as humanly possible, ideally under 10%. Third, making up 15% of your score, is the length of your credit history. Lenders love to see a long, stable history of responsible credit use. This is why one of the biggest myths we'll bust in a minute is so dangerous. The age of your oldest account, your newest account, and the average age of all your accounts matter. Time is your ally here. Fourth, at 10% is your credit mix. Lenders like to see that you can responsibly manage different types of credit, like a credit card, a car loan, and maybe a student loan. It shows you're a versatile and experienced borrower. You don't need to go out and get new loans just for this, but it's a factor to be aware of. And finally, the last 10% is new credit. This looks at how many new accounts you've opened recently and how many times lenders have pulled your credit. What's known as a hard inquiry. Opening too many new accounts in a short period can make you look desperate for credit, which spooks lenders. Now let's see how this plays out in the real world. Meet 2 potential homebuyers, Alex and Ben. They both work at the same company, make the exact same salary, and have saved up the exact same 20% down payment for a $400,000 house. On paper, they are identical, but their financial stories, their credit scores, are worlds apart. Alex has a sparkling 780 FICO score. Ben has a 640. Ben, trying to be financially responsible, fell for a classic myth. He had an old credit card from college that he never used. It had a $5,000 limit and a perfect payment history. He thought, I should clean up my finances. So he called the company and closed the account. He felt so proud. But what he actually did was commit financial self-sabotage. By closing his oldest account, he shortened the average length of his credit history, hurting 15% of his score. Worse, by wiping out that $5,000 credit limit, he instantly increased his overall credit utilization ratio on his other cards, damaging another 30% of his score. His score dropped 30 points overnight from one smart decision. Alex, on the other hand, knew the secret. Alex also had an old and used card. But instead of closing it, Alex used it to buy a pack of gum once every few months and paid it off immediately just to keep it active. That long, positive history continued to anchor his score, boosting that crucial length of credit history factor. Then there's the utilization myth. Ben believed that to have a good credit score, you need to carry a small balance on your credit cards from month to month. He thought it showed the credit card companies he was an active, profitable customer. So he'd always leave $100 or $200 on his statement, paying interest for no reason. What he didn't realize is that lenders don't care if you're profitable for the credit card company. They care if you're a risk. By carrying a balance, Ben was consistently reporting a higher credit utilization, which suppressed his score. Alex knew the real hack. Alex used his credit cards for everything to get the points, but he lived by a rule: pay the statement balance to zero in full every single month before the due date. Even better, Alex used a technique insiders call AZEO, all zero except one. A week before his statements were due to report to the bureaus, Alex would pay off every single one of his credit cards completely, except for one. On that one card, he'd leave a tiny balance like $9. Why? Because some scoring models give you a slight penalty if all of your revolving accounts report a zero balance. By having one card report a tiny non-zero balance, he signaled activity without having high utilization. His score skyrocketed. But the biggest difference came from a mistake Ben made years ago. He had one late payment on a car loan from 3 years back. It was only a few days late, but it was a black mark on his report, wrecking that all-important 35% of his score. He just assumed he had to live with it for 7 years. Alex also had a late payment once. He was on vacation and forgot a bill. But Alex didn't accept defeat. He wrote something called a goodwill letter to the creditor. He politely explained the situation, highlighted his otherwise perfect payment history with them, and simply asked if they would consider making a goodwill gesture by removing the late payment from his credit report. It's not guaranteed to work, but it costs nothing but a stamp. In Alex's case, the creditor agreed. That one letter erased the single biggest negative item on his report, boosting his score by over 50 points. So when Alex and Ben go to the same lender for the same $400,000 loan, what happens? Alex, with his 780 score, is treated like royalty. He's offered a prime interest rate, let's say 6.5%. His monthly principal and interest payment is about $2,528. Ben, with his 640 score, is seen as a risk. The lender is hesitant. They eventually offer him a loan, but at a much higher subprime rate, maybe 8%. His monthly payment for the exact same house is $2,935. That's a difference of $407 every single month. Over the course of a year, that's nearly $5,000. And over the 30-year life of the loan, Ben will pay over $146,000 more than Alex for the exact same house. All because of a 3-digit number he didn't understand. Your credit score is not just a number. It's leverage. It's a direct reflection of your financial habits, and mastering it is the single most powerful thing you can do to prepare for a mortgage. Take the time to pull your reports. You can do it for free and check for errors. See where you can apply Alex's strategies. Dispute any inaccuracies. Because once your financial story is in pristine condition, you're ready to take the next, and perhaps most exciting step: proving to the banks you can actually afford the house. This next stage is where the rubber truly meets the road. It's about getting that coveted piece of paper that transforms you from a window shopper into a serious contender with real power. It's called the pre-approval letter. And in the next part, we're going to walk you through exactly how to get this golden ticket, revealing the documents you need to gather right now, and how to use it as a weapon to get the best possible deal on your dream home. Alright, let's talk about getting that golden ticket. The pre-approval letter isn't just a piece of paper. It's your official entry into the serious home buying game. It's the document that transforms you from a window shopper into a power buyer in the eyes of real estate agents and, more importantly, home sellers. When you submit an offer with a pre-approval letter, you're not just saying, "I like your house." You're saying, "A financial institution has already examined my finances and has tentatively agreed to lend me a specific amount of money to buy your house. I am a serious, credible threat to buy this property." That's the power we're talking about. So how do you get it? It starts with a document treasure hunt. The lender's job is to build a complete, verifiable puzzle of your financial life. Your job is to give them all the pieces. To make this simple, let's break it down into 4 key categories. Think of the acronym PI: proof, assets, income, and debts. First, P for proof of identity. This is the easy part. The lender needs to know you are who you say you are. You'll need a clear copy of your government-issued photo ID, like a driver's license or passport, and a copy of your social security card. Simple enough. Next, A for assets. This is where you prove you have the cash to close the deal. Lenders need to see where your down payment, closing costs, and required cash reserves are coming from. Get ready to gather the last 2 to 3 months of statements for every single financial account you have. This means checking accounts, savings accounts, money market accounts, and any investment accounts like a 401k, IRA, or brokerage account. Don't leave anything out. The lender will scrutinize these statements, looking for consistent balances and any large, unusual deposits. And that brings up a critical point: cash. If you have a mattress stuffed with $20,000 for your down payment, that's a problem. Lenders call this unseasoned funds, and they can't use it. Any large, non-payroll deposit needs a paper trail. If your parents gave you $20,000 to help with the down payment, that's fantastic, but you can't just deposit the check. You'll need what's called a gift letter. This is a formal letter from the person giving you the money stating that the funds are a true gift, not a loan, and that they have no expectation of being paid back. They will also need to provide a bank statement showing they had the funds to give. It feels intrusive, but it's a non-negotiable step to prevent fraud and money laundering. Now for the biggest category of all, I for income. This is the absolute core of your application. The lender's primary concern is your ability to repay the loan for the next 30 years. They need to see a history of stable, reliable, and predictable income. If you're a W-2 employee, meaning you get a regular paycheck from an employer, this is fairly straightforward. You'll need your most recent pay stubs covering a 30-day period. You'll need your W-2 forms from the last 2 years. And you'll likely need your full federal tax returns, including all schedules, for the last 2 years. The lender is looking for consistency. If you've been at the same job for 5 years with steady raises, that's a green light. If you recently switched jobs, don't panic. As long as it was in the same field and resulted in a pay increase, it's usually seen as a positive. They just don't want to see unexplained gaps in employment or a sudden drastic career change with a pay cut right before you apply for a massive loan. But what if you're self-employed, a freelancer, or a gig worker? The process is more intense but absolutely doable. Since you don't have W-2s to prove your income, your tax returns become the holy grail. You will need, at a minimum, your last 2 years of complete personal and business tax returns. The lender will typically take your net income, your profit after expenses, from the last 24 months and average it out to determine your qualifying monthly income. This is a shock to many self-employed people who are brilliant at using write-offs to lower their taxable income. Remember, for the purpose of a mortgage, you want to show the government you made as much money as possible, not as little. You'll also likely need to provide a year-to-date profit and loss statement and prove your business is still active and stable. The key here is meticulous organization. The more professional and organized your financial documents are, the more confidence you'll instill in the lender. Finally, we have D for debts. The lender needs to know what you owe to calculate your debt-to-income ratio, or DTI. This means providing recent statements for any outstanding debts. We're talking about car loans, student loans, credit cards, and any other installment loans. They need to see your total balance and, more importantly, your minimum monthly payment for each account. Even if you pay your credit card off in full every month, they will still use the minimum payment shown on your statement for their calculation, or a percentage of the balance if no payment is listed. You'll also need to disclose obligations that might not be on your credit report, like alimony or child support payments. Be brutally honest here. Hiding a debt is one of the fastest ways to get your application denied later in the process. Okay, you've climbed the document mountain. You have your PayID folder ready to go. What now? Now you officially apply. You'll work with your chosen loan officer to complete the Uniform Residential Loan Application. It's a lengthy, detailed form, but it's the standard across the industry. This is the moment of truth where you give the lender explicit permission to pull your credit. This is called a hard inquiry or a hard pull. And yes, it can cause your credit score to dip by a few points temporarily. But do not let this scare you. First, it's a necessary part of the process. Second, the credit scoring models are smart. They know that when you're shopping for a mortgage, you're going to talk to multiple lenders. To account for this, any mortgage-related hard inquiries that occur within a 30 to 45-day window are typically bundled together and treated as a single event. So you are free to shop around for the best rate without fear of wrecking your credit score. Once you submit the application and your documents, the file goes to a loan processor and then an underwriter for a preliminary review. They'll verify your income, check your assets, and run your credit. They're essentially stress testing your financial puzzle to make sure all the pieces fit. If everything checks out, you'll receive it, the pre-approval letter. This letter is your weapon. It will state the loan type you're approved for, the loan amount, and the interest rate, though the rate is often subject to change. Now you can hunt for a home with confidence. You know your exact budget, which prevents the heartbreak of falling for a home you can't afford. When you find the one, your real estate agent will submit your offer along with your pre-approval letter. Imagine the seller looking at two identical offers. One has a pre-approval letter, proving the buyer is financially vetted and ready to go. The other doesn't. Which offer do you think they're going to accept? Yours. Every single time. It signals a lower risk of the deal falling apart. And in real estate, certainty is king. It can even give you negotiating leverage, because you're demonstrating you can close the deal quickly and without financing drama. You have the letter in your hand, you feel invincible, and you're ready to find your dream home. But be warned. You are now entering what is arguably the most dangerous phase of the entire process. The period between getting pre-approved and closing on the house is filled with hidden traps. There are a handful of seemingly innocent financial moves you can make that will instantly invalidate your approval, forcing your lender to pull the plug on your loan and shattering your homeownership dreams just days before you were supposed to get the keys. So let's talk about the mortgage minefield. These are the financial landmines you can step on during the underwriting process that will detonate your deal. The first and most common is making a large unexplained cash deposit into your bank account. This seems completely backward, right? You're trying to buy a house, more money is good. The lender should be happy to see your savings grow, but they aren't. In fact, it sends them into a panic. Here's why. Lenders are legally required to source every single dollar you're using for your down payment and closing costs. This is to comply with federal anti-money laundering laws and more practically for you, to ensure you're not taking on a secret, undisclosed loan. Imagine your uncle gives you $20,000 in cash he's been saving under his mattress for years. You gratefully deposit it. The underwriter sees this massive random deposit appear out of thin air, and their first thought isn't, "Oh, what a nice uncle." Their first thought is this a loan? Is this person now secretly in debt to their uncle for 20 grand? Because if they are, that monthly payment isn't factored into their debt-to-income ratio, and they might not actually qualify for this mortgage. Any large, non-payroll deposit will trigger a demand for a paper trail. You'll need to prove where it came from. If it's a gift, you'll need a formal gift letter signed by the person who gave you the money, stating explicitly that it is a gift and not a loan that requires repayment. You'll also need a copy of their bank statement showing the money leaving their account. If you sold something, you'll need a bill of sale. If you can't source it, the lender can't use it. They will disregard that money entirely and might even view your entire application with suspicion. The rule is simple. Before you deposit any amount of cash larger than a few $100s, call your loan officer and ask them exactly how to document it. The second deal killer is applying for new credit of any kind. This is the classic heartbreaking mistake. You're pre-approved, you've found the house, you're excited. You start thinking about furniture. You walk into a store, and they offer you 0% financing for 2 years and an extra 15% off if you open a store credit card. Sounds like a great deal. So you do it, and you've just shot yourself in the foot. Applying for that card triggers a hard inquiry on your credit report. That alone can ding your score by a few points. But the real damage is the new line of credit. Let's say you buy $5,000 worth of furniture. Your total debt has now increased by $5,000, and your future monthly payments have gone up. This immediately changes your debt-to-income ratio, the very number that your entire approval was based on. Lenders do what's called a credit refresh, just a few days before your closing date. They pull your credit one last time to make sure nothing has changed. When they see that new inquiry and that new $5,000 debt, alarms go off. If that new payment pushes your DTI over their limit, even by a single percentage point, they can, and often will, deny the loan right there on the spot. You could be 3 days from getting your keys and get a call that the entire deal is off. So do not finance a car. Do not open a new credit card. Do not co-sign a loan for your cousin. Do not buy a single piece of furniture on credit. Your financial life must be completely frozen until after you close. The third landmine is changing jobs. Now this one is nuanced. It's not an automatic deal killer, but it is incredibly risky and you must handle it with extreme care. Lenders base your approval on stability. They've verified your employment with your current company, they've analyzed your pay stubs, and they've built your qualification profile around that specific stable income. When you change jobs, you introduce a massive variable into that equation. Even if the new job is for more money, the underwriter gets nervous. Is it in the same industry? If you're going from a salaried accounting job to a commission-only sales job, that's a huge red flag. Is there a probationary period at the new company? Most lenders won't close a loan for a borrower who is in a 90-day probationary period. They need to see that the employment is stable. The absolute worst thing you can do is change jobs and not tell your lender. Because just like they do a credit refresh, they also do a final verification of employment. They will call your old HR department a day or two before closing to confirm you still work there. Imagine their shock when HR says, "Oh, they left the company last week." The entire process comes to a screeching halt. Your loan has to be resubmitted and re-underwritten with your new employment information, assuming you even have a pay stub from the new job yet. This can cause delays that breach your contract deadlines, potentially causing you to lose the house and your earnest money deposit. If you are considering a job change, the first call you make should be to your loan officer. They can guide you on whether it's feasible and what documentation you'll need to make it work. But if you can avoid it, stay put. Fourth, and this should be obvious but it happens all the time, do not miss any payments on your existing bills. The home buying process is chaos. You're juggling inspections, appraisals, paperwork, and packing. It's easy for a simple credit card bill or a car payment to slip through the cracks. But a single 30-day late payment can be catastrophic. It can plummet your credit score by 50 to 100 points overnight. If that score drop pushes you below the lender's minimum requirement, your loan is dead. Even if it doesn't disqualify you completely, it could push you into a higher interest rate bracket, forcing the lender to restructure your entire loan at a higher monthly payment you may no longer afford. During this period, put every single one of your bills on autopay. Don't leave it to chance. The fifth mistake is one of the most counterintuitive: suddenly paying off a large debt or closing old credit accounts. You might think you're helping. You think, "I'll just drain my savings and pay off my student loan. That will eliminate the debt and make my DTI look amazing." But the underwriter sees it differently. They see your cash reserves, the money you need for your down payment, closing costs, and emergency fund, suddenly vanish. This makes you look financially fragile, not stronger. Similarly, you might decide to close out an old credit card you never used to clean up your finances. This can actually hurt your credit score. Closing an account reduces your overall available credit, which increases your credit utilization ratio. If you have balances on other cards, your utilization percentage suddenly spikes, which can lower your score. It also can reduce the average age of your credit history, another key factor in your score. The rule is to leave everything as is. Be boring. Don't make any large-scale financial moves unless your loan officer specifically tells you to as a condition of your loan. Finally, the sixth and perhaps most devastating landmine is having a tax issue. If you are self-employed or have a side hustle and you owe money to the IRS, you need to be on a formal documented payment plan. If you ignore your tax obligations, the IRS can place a federal tax lien on you. A tax lien is the ultimate mortgage killer. It's a legal claim against all your assets, and it takes priority over a mortgage lender. No lender in the country will approve your loan until that lien is fully paid and released, a process that can take many months. So the golden rule through this entire underwriting phase is this: your financial life needs to enter a state of suspended animation. Your one and only job is to look exactly the same on closing day as you did on the day your application was submitted. No new debt, no new jobs, no mysterious money, no late payments. Just keep earning your income and paying your bills on time. The mantra is, when in doubt, call your loan officer. Don't make a move, don't transfer a dollar, don't sign a thing without asking them first. That 5-minute call can be the difference between getting the keys to your dream home and watching it all fall apart at the last second. So you've frozen your credit, you've kept your job, and you've documented every penny. The underwriter has finally finished their deep dive into your life. What happens next is one of the most exhilarating and terrifying moments in the entire process. You get the call. But what if it's not the yes you were expecting? What if it's a yes, but with a list of last-minute high-stakes conditions you have to meet in just 48 hours? That's where we're going next. The final countdown to your clear to close. This is the moment the entire process feels like it's balancing on the head of a pin. You've been approved conditionally. That phrase, conditional approval, is both the best and worst thing you can hear. It's a green light, but it's flickering. It means the underwriter has reviewed your entire life on paper and said, "Yes, this looks good. If you can just prove these last few things and do it right now." The clock starts ticking and it ticks loud. This isn't a drill. This is the final exam and it's open book, but all the questions are trick questions. Your loan officer calls, their voice a mix of congratulations and urgency. "We're so close," they'll say. "The underwriter just needs a few final items to issue the clear to close." And then comes the list. A list that can feel completely random and borderline insane. Welcome to satisfying underwriting conditions. The first and most common condition is the last-minute employment check. You're thinking, but I already gave you my pay stubs, my W-2s for the last 2 years, and my offer letter. You called my boss 3 weeks ago. What more could you possibly need? What they need is proof that you still have that job today. Literally. Lenders are terrified of lending hundreds of thousands of dollars to someone who just got laid off or quit their job a week before closing. So they will perform what's called a verbal verification of employment, or VVOE. They will call your HR department, sometimes just 24 or 48 hours before the closing date, with 2 simple questions. Is Jane Doe still employed here? And is her position and income the same? If the answer to both is yes, you're golden. But what if your HR person is on vacation? What if they don't answer the phone? This is where you become the world's most persistent, yet polite, project manager. You get the direct line and email of the exact person who can verify your employment. You give your HR department a heads up that a call is coming. You don't leave this to chance. A missed call can absolutely delay your closing. This is the lender's final check to make sure the foundation of your entire application, your income, is still standing firm right before they hand over the money. Next up is the condition that drives people absolutely crazy: sourcing large deposits. Throughout the process, you've been told not to move money around. But life happens. Maybe you sold your car on Craigslist for $5,000 in cash. Maybe your parents gifted you $10,000 for the down payment. Maybe you got a big work bonus. You deposited that money into your account, and now, on the final bank statement you provide, the underwriter sees it. To you, it's just money. To an underwriter, it's a giant flashing red question mark. They will issue a condition. Please source the large deposit of $5,000 on March 15th. This isn't because they're nosy. It's because of federal anti-money laundering laws like the Patriot Act. They have a legal obligation to ensure the money you're using to buy a home came from legitimate sources and isn't just a secret, undocumented loan from a friend that you have to pay back. A secret loan would be an undisclosed debt, and that would change your entire debt-to-income ratio. So how do you handle it? You document everything. For the cash from the car sale, you'll need a copy of the signed title, a bill of sale, and even a copy of the Craigslist ad to prove where that cash came from. For the gift from your parents, you'll need a signed gift letter, a document your lender provides, stating clearly that the money is a gift and not a loan. You'll also need a paper trail showing the money leaving their account and entering yours, like a copy of the check and your deposit slip. For the work bonus, you'll need the pay stub that shows the bonus as a line item, and maybe even a letter from your employer explaining it. The key is to create an undeniable black and white paper trail for every single dollar that appears out of thin air. Be prepared for this. Review your own bank statements before you send them and get your documentation ready. Then comes the final credit check. Right before they fund your loan, the lender will do one last soft pull of your credit. It's not a full score-damaging hard inquiry, but it's a peek. They are looking for one thing: did you do anything stupid? Did you, in the final weeks of the most important financial transaction of your life, decide it was the perfect time to finance a new sectional sofa, lease a new car, or open a Best Buy credit card to get a discount on a TV for the new living room? This is the cardinal sin of the mortgage process. Do not, under any circumstances, open a new line of credit or make a major purchase on credit between your application and your closing. Even a small new monthly payment of $100 can throw your debt-to-income ratio out of whack and cause the underwriter to deny the loan at the finish line. Imagine running a 26-mile marathon and in the final 10 feet stopping to tie your shoe, getting a cramp, and being unable to finish. That's what this is. Your credit cards? Keep the balances low or at zero. Your car? Keep driving the one you have. Your furniture? Sit on the floor for a week if you have to. The celebration comes after you have the keys in your hand, not before. Finally, there are the property-related conditions. These come from the appraisal or the title search. The appraiser might have noted a safety issue, like a missing handrail on a deck, a broken window, or exposed electrical wiring. The lender will not fund a loan on a property they consider unsafe. The condition will be clear. Provide evidence that the handrail has been installed. This now becomes a frantic negotiation with the seller. You have to get them to agree to fix it, get it done, and then provide photographic proof or even pay for an appraiser to go back out, all within a day or two. Or the title company might find a cloud on the title. This could be an old, unpaid lien from a contractor, or an unresolved claim from a previous owner's divorce. The title must be clear for the sale to go through. This condition requires lawyers and the title company to scramble to resolve old issues. While you can't fix this one yourself, your job is to stay in constant communication with your realtor and loan officer to make sure it's being handled. You will feel like you're juggling flaming torches while riding a unicycle. You're uploading documents at midnight, making calls on your lunch break, forwarding emails with subject lines like, "Urgent final docs for closing." But with each condition you satisfy, you are one step closer. You send the final pay stub. You upload the gift letter. You get the photo of the new handrail from the seller's agent. Each document you send is a response to the underwriter's final questions. And then silence. It might be a few hours. It might be a full day. You refresh your email 1,000 times. You stare at your phone, willing it to ring. And then it does. It's your loan officer. But this time their voice is different. The urgency is gone. It's replaced with genuine excitement. And they say the 3 most beautiful words in the entire home buying process. You're clear to close. The flickering green light is now solid. The conditions have been met. The underwriter has given their final, unconditional blessing. The bank is officially ready to send the money. You did it. You survived the final trial by fire. But getting the clear to close triggers one last critical step. You're about to receive a document so important that federal law requires you to stop everything and review it for 3 full days before you're allowed to sign anything else. It's called the closing disclosure, and it contains the final, exact numbers for your entire transaction. And understanding it is the key to ensuring there are no terrifying surprises at the closing table. This 5-page document is your final report card for the entire deal. It's the truth serum for your mortgage. And by law, your lender must give it to you at least 3 full business days before you're scheduled to close. This isn't just a suggestion. It's a federal law called the TILA-RESPA Integrated Disclosure Rule, or TRID. And that 3-day window is your golden opportunity. It's a mandatory cooling-off period designed to protect you, to give you time to review every single line item without a notary breathing down your neck and a seller tapping their foot in the hallway. This is your time to find mistakes, ask questions, and get answers. So let's treat this document with the respect it deserves and break it down, page by page. The very first thing you should do when you get your closing disclosure or CD is pull out that loan estimate you received weeks ago. Remember that? The document that gave you the projected costs? The closing disclosure is the final actual cost. You are going to put these 2 documents side by side. Think of the loan estimate as the menu with the prices, and the closing disclosure as the final, itemized bill that arrives after the meal. Your job is to make sure the bill matches the menu, and if it doesn't, to understand exactly why. Page 1 is your executive summary. It's designed to give you the most critical information at a single glance. Up top, you'll see the closing date, property address, and your names. Check these first. A simple typo here can cause massive headaches later. Below that, you'll see the core loan terms, the loan amount, the interest rate, and your monthly principal and interest payment. Does that interest rate match the one you locked? It absolutely must. If it doesn't, stop everything and call your loan officer immediately. Then you get to the 2 big boxes, projected payments and costs at closing. The projected payments section breaks down your total monthly housing expense, often called PITI, principal, interest, taxes, and insurance. It will show your principal and interest, which is a fixed amount on a fixed-rate loan, and then the estimated monthly cost for homeowners insurance and property taxes that will be paid from your escrow account. We'll dive deeper into escrow in a minute. This section might also show mortgage insurance if you have it. This is the number you need to be comfortable with because you'll be paying it every single month for a very long time. The second big box is costs at closing. This shows 2 numbers that will make your heart skip a beat: the closing costs and the all-important cash to close. Closing costs is the total sum of all the fees and expenses to finalize the mortgage. But the number you really care about is cash to close. This is the exact amount of money you need to bring to the closing table. It's your down payment, plus your closing costs, minus your earnest money deposit and any credits you're receiving from the seller or lender. This is the final check you'll have to write. It should be close to what you expected, but now it's a hard number. Now turn to page 2. This is the nitty-gritty, the detailed breakdown of that closing costs number from page 1. It's split into 2 main columns: loan costs and other costs. Loan costs are all the fees your lender and third-party services are charging to create the loan. you'll see things like the origination fee, which is what the lender charges for their work, application fees, and underwriting fees. You'll also see fees for services you had to use, like the appraisal fee, the credit report fee, and the flood determination fee. This page is where your side-by-side comparison with the loan estimate becomes critical. By law, some of these fees have a zero tolerance, meaning they cannot change from the loan estimate to the closing disclosure at all. This includes the lender's origination charge, and if you used a provider recommended by the lender, the cost of third-party services like the appraisal. Other fees have a 10% tolerance, meaning the total cost of that group of fees can't increase by more than 10%. And finally, some fees have no tolerance limit, like your prepaid homeowner's insurance, because you were free to shop for that yourself. If you see a major increase in a fee that should have had zero or limited tolerance, that's a red flag. The other costs column includes things that aren't directly related to the lender. This is where you'll see taxes and other government fees, like recording fees for the deed. You'll also see your prepaids, which are costs you pay at closing for items that will actually be due later. This includes a full year of homeowners insurance premiums and any prepaid daily interest on the loan. Finally, you'll see the initial escrow payment at closing. This is the seed money for your escrow account. The lender will collect a few months of property taxes and homeowners insurance premiums up front to make sure there's a big enough cushion in the account to pay those bills when they come due. Page 3 is the math problem. It shows how everything gets calculated. You'll see a table called Summaries of Transactions, with a borrower's transaction column and a seller's transaction column. This looks intimidating, but it's really just a ledger. The borrower side shows all your debits, the things you owe like the sales price, and all your credits, the things that have already been paid or are being paid by others like your loan amount and your earnest money deposit. This is also where you must verify any credits the seller agreed to pay. If they promised you $5,000 toward closing costs in the purchase contract, you need to see that $5,000 credit listed right here. The bottom line of this complex table will, once again, equal that all-important cash to close figure from page 1. It's just showing you the work. Page 4 is the legal fine print. It contains key disclosures about your loan. It will tell you whether or not your loan has a demand feature, which is rare, or if there's a penalty for paying the loan off early, which you should have already known about. Most importantly, it will detail your escrow account. It will state whether or not you have one, and if you do, it will break down what's included, usually property taxes and homeowners insurance. It will estimate your escrow payments for the first year and explain that the amount can change over time if your taxes or insurance premiums go up or down. This is crucial to understand. Your total monthly payment is not necessarily fixed for 30 years if you have an escrow account. Only the principal and interest part is. The tax and insurance portion can fluctuate. Finally, we arrive at page 5. This is the wrap-up. It shows your loan calculations, giving you the total amount you will have paid over the entire life of the loan, principal, interest, mortgage insurance, and loan costs. Brace yourself, this number is always huge and a little bit sickening. It also shows your annual percentage rate or APR. Remember, the interest rate is the cost of borrowing the money, while the APR is a broader measure of the cost, including the interest rate plus some of the fees expressed as a yearly rate. It's a more apples-to-apples way to compare loans. And then there's a number called the total interest percentage, or TIP. This tells you how much interest you will pay over the life of the loan, expressed as a percentage of the loan amount. For a 30-year loan, it's not uncommon for this number to be over 100%, meaning you'll pay more in interest than the amount you originally borrowed. It's a sobering reminder of the long-term cost of a mortgage. At the bottom of this page, you'll find the contact information for everyone involved in the transaction: the lender, the real estate brokers, the closing agent. This is your roster. If you have a question, this list tells you who to call. So you've reviewed all 5 pages. You've compared it to your loan estimate. What now? You acknowledge receipt. Signing the closing disclosure does not mean you are accepting the loan. It is simply a legal acknowledgement that you have received the document, and it officially starts that 3-day review clock. Use this time wisely. If anything, a name, a number, a fee looks wrong or different than you expected, pick up the phone. Call your loan officer. Call your real estate agent. Do not be shy. This is potentially the largest financial transaction of your life, and you have every right to understand it completely. These 3 days are your power. They are your final line of defense against costly mistakes. With the numbers locked in and your 3-day review period underway, you're now entering the final 72 hours of the marathon. But before you wire a single penny of your life savings, there's one last critical mission you have to undertake at the property itself. A final check to ensure the home you're about to own is in the exact condition you expect it to be. This mission is called the final walkthrough. It's not a formality. It's not a casual stroll through your future home. It is your absolute last line of defense against buying a property with a costly last-minute disaster. This is your final opportunity to verify that the home is in the same, or better, condition than when you sign the purchase agreement. It typically happens 24 to 48 hours before you're scheduled to sign the final papers, and you absolutely must not skip it. So what are you looking for? You're not redoing the home inspection. You're a detective on the hunt for 3 specific things: compliance, condition, and completion. First, compliance. You need to bring a copy of your purchase agreement and the inspection repair addendum. Remember those repairs you negotiated with the seller? The leaky faucet they promised to fix? The cracked window pane they agreed to replace? Now is the time to verify with your own eyes that every single one of those repairs has been completed to a satisfactory standard. Don't take their word for it. Check the receipts if they have them, but more importantly, test the fix. Turn on that faucet. Look under the sink. Confirm the new window pane is installed correctly. If the work isn't done, or it's done poorly, you need to raise hell with your agent immediately. This is a breach of contract, and it needs to be resolved before you sign anything. Second, condition. A lot can happen in the 30 to 60 days since you were last in the house. Most critically, the sellers have been moving out. And moving is chaos. Walls get scuffed, floors get scratched, and sometimes, heavy furniture leaves behind unexpected damage. You're looking for any new problems that weren't there before. Check the walls for fresh gouges. Look at the hardwood floors for deep scratches that weren't under the seller's area rug. You are buying the house in the condition you agreed to, not the condition it's in after a clumsy moving crew has had their way with it. Third, completion. This is about what's there and what isn't. Your purchase agreement meticulously lists inclusions and exclusions. Inclusions are items that are supposed to stay with the house: the refrigerator, the washer and dryer, the custom window blinds, that fancy chandelier in the dining room. You need to walk through, list in hand, and confirm every single included item is still there and in working order. Yes, that means you need to test them. Open the fridge and freezer to make sure they're cold. Run a quick rinse cycle on the dishwasher. Turn on the stove burners. You'd be shocked how many buyers get their keys only to find out the sellers swapped the high-end stainless steel appliances for cheap replacements, or simply took them, hoping you wouldn't notice until it was too late. Equally important is making sure everything that was supposed to go is actually gone. The sellers are required to remove all of their personal property. You are not buying their junk. Check the basement, the attic, the garage, and any sheds. You don't want to be responsible for hauling away piles of old tires, half-empty paint cans, and broken furniture on your first weekend as a homeowner. The property should be broom clean at a minimum. If you find an issue during the final walkthrough, a repair not done, new damage, a missing appliance, you don't panic. You document. Take clear photos and videos. Then you immediately call your real estate agent. This is what you pay them for. They will contact the seller's agent and figure out a solution before closing. This might mean the seller has to pay a contractor directly, or more commonly, they'll provide a credit to you at closing to cover the cost of the repair. The absolute worst-case scenario is delaying the closing, but that is far better than inheriting an expensive problem that is no longer the seller's responsibility the second you get the keys. Once you've signed off on the physical state of the house, your focus must pivot immediately to the financial state of the deal. Because at almost the exact same time as your final walkthrough, the single most important document of the entire mortgage process will arrive in your inbox. It's a 5-page form from your lender called the Closing Disclosure, or CD, and it comes with a rule, a very important legally mandated rule. The lender must deliver the closing disclosure to you at least 3 full business days before your scheduled closing. This isn't a suggestion, it's federal law. The TRID rule designed to protect you, the consumer. This 3-day window is a mandatory cooling-off period. It forces you to stop, take a breath, and review the final concrete numbers without a lawyer and a seller staring you down at a closing table. So what is this document? Think of it as the final bill for the biggest purchase of your life. It itemizes every single dollar and cent involved in your transaction. Your job during these 3 days is to compare it, line by line, against the loan estimate you received at the very beginning of this journey. The loan estimate was the promise. The closing disclosure is the proof. You need to pull up both documents side by side, and play a game of spot the difference. Start on page 1. Compare the core loan terms, the final loan amount, the interest rate, the monthly principal and interest payment, and whether there's a prepayment penalty. These numbers should match your loan estimate exactly. If your interest rate is suddenly an eighth of a point higher, you need to make a call. Now, then turn to page 2. This is the breakdown of all the closing costs, the section called loan costs and other costs. This is where it gets a little more complex, but the government has created categories to help you. Some fees have zero tolerance, meaning they cannot, by law, be any higher on the closing disclosure than they were on your loan estimate. This includes the lender's origination fee, any discount points you paid to lower your rate, and the appraisal fee if you used an appraiser from the lender's list. If these numbers have increased by even $1, the lender has to eat the difference. It's their mistake, not yours. Other fees have a 10% cumulative tolerance. This is a bucket of costs for third-party services that the lender requires, where you were allowed to shop but chose from their approved list. Think title insurance, settlement services, and recording fees. The cost of any single one of these items can go up, but the total for the entire bucket cannot increase by more than 10% from the loan estimate. Finally, there are fees with unlimited tolerance. These can change by any amount, and it's usually for a good reason. This category includes things like prepaid interest, property taxes, and your homeowner's insurance premium. The lender can't perfectly predict these. For example, you might have chosen a more expensive homeowner's insurance policy than they initially estimated. That's okay as long as you understand why it changed. The most important number on the entire document is at the bottom of page 3, the cash to close. This is it. This is the final, exact amount of money you need to bring to closing. This number takes your down payment, adds in all your closing costs, and then subtracts any credits you're receiving, like your earnest money deposit or any credits from the seller for repairs. This is the number you will be wiring or bringing as a cashier's check. Needs to be right. If you find any discrepancies, any numbers you don't understand, or any fees that seem out of place, you do not wait. You immediately contact your loan officer and your real estate agent. Most of the time, it's a simple clerical error, a typo, a misplaced decimal point that can be corrected quickly, but you have to be the one to catch it. Don't assume it's correct. Verify everything. If a major change is required, like the loan product itself changes or the annual percentage rate, the APR, increases by more than a tiny fraction, it can trigger a new 3-day review period, which could delay your closing. This is why it's so critical to review the closing disclosure the moment you get it. With the walkthrough complete and your closing disclosure reviewed and approved, you've officially navigated the financial labyrinth. The house is ready. The numbers are final. All that's left is to show up, sign your name on a mountain of paper, and receive the one thing you've been working towards this whole time: the keys to your new home. And what exactly happens in that closing room is what we're covering next. You'll walk into a conference room, likely at a title company or an attorney's office. The air will feel formal, but also electric with anticipation. In the room, you'll find your real estate agent, a closing agent, and maybe the seller's agent. Sometimes the sellers are there, sometimes they've pre-signed their documents, but the most intimidating thing in the room won't be the people. It'll be the stack of paper waiting for you on the table. It looks like a novel written in a language you don't understand. Legalese. This is closing day. Your job here is simple but critical: sign, sign, and sign again. But you're not just signing blindly. You are executing the largest financial transaction of your life. The closing agent is your guide. They'll walk you through each document, giving you a brief explanation. But let's focus on the heavy hitters, the documents that truly matter. First up, you'll see a familiar friend, the closing disclosure, or CD. You already received a version of this at least 3 business days ago. The one you're signing now is the final official version. Your mission, and you should absolutely choose to accept it, is to compare this final CD with the one you already reviewed. Do the numbers match? Is the interest rate correct? Is the loan amount what you expected? And most importantly, does the cash to close figure match what you were told to bring? This is your last chance to catch any errors. Don't be afraid to speak up and ask questions. A good closing agent will patiently answer every single one. This is your money, your future. Take your time. Next comes the promissory note. If the closing disclosure is the receipt, the promissory note is the IOU. This document is your personal, legally binding promise to repay the loan. It spells out the total amount you're borrowing, the interest rate, your monthly payment amount, and the dates those payments are due. It also details what happens if you fail to pay. This isn't the mortgage itself. It's the core promise that underpins the entire loan. When you sign this, you are formally accepting the debt. Then you'll get to the document that most people think is the mortgage itself, or in many states, a deed of trust. What's the difference? Functionally, for you as a borrower, not much. Both documents do the same crucial thing: they secure the loan. They are the lender's collateral. By signing this, you are giving the lender a legal interest in your property. It's the document that says, if I don't honor the promise I made in the promissory note, the lender has the right to take this house back through foreclosure to get their money. It's a sobering document, but it's the bedrock of how mortgage lending works. It's what makes the whole system possible. And finally, the most exciting piece of paper in the entire stack: the deed. This isn't a loan document. This is the one. This is the legal instrument that officially transfers ownership of the property from the seller to you. The closing agent will ensure it's properly executed, and after the closing, we'll have it recorded with the county. Once that deed is recorded with your name on it, you are the official legal owner of the property. After signing what feels like a forest's worth of paper, you'll hand over the money. Not a personal check, but a certified cashier's check or proof of a wire transfer for that cash-to-close amount. The funds are verified, the documents are signed and notarized, and then it happens. Someone slides a set of keys across the table. They're yours. All the stress, the paperwork, the waiting, it all melts away in that one moment. You did it. You are a homeowner. But the journey isn't quite over. Owning the home is a new adventure, and there are a few final housekeeping items you need to know about right after you leave that closing room. First, your first mortgage payment. You might assume it's due on the first of the very next month, but that's rarely the case. At closing, you paid prepaid interest, which covers the interest on your loan for the remaining days of the month you closed in. Your first full mortgage payment will typically be due on the first day of the month after the next month. So if you close on May 15th, your first payment won't be June 1st. It will be July 1st. You'll get a coupon book or a letter from your lender a couple of weeks after closing confirming all of this. Second, remember that escrow account we talked about? Your monthly payment isn't just for the loan principal and interest. A portion of it goes into your escrow account to cover your property taxes and your homeowner's insurance. You don't have to worry about saving up for those big, scary bills twice a year. The lender manages it for you, collecting 1/12 of the estimated annual cost each month and paying the bills on your behalf when they're due. You'll get an annual statement showing what was collected and what was paid out. Third, and this is a big one that surprises a lot of new homeowners, the company you send your mortgage check to might change. It is extremely common for your original lender to sell your loan to a larger loan servicer. This does not mean your loan has been changed. Your interest rate, your monthly payment, the amount you owe, all the terms you agreed to in your promissory note are legally locked in and cannot be changed. All that changes is the address where you send the payment. You'll receive 2 letters in the mail: a goodbye letter from your old lender and a hello letter from your new servicer. It's a standard and frankly boring part of the business. And one final pro-level tip that can save you thousands of dollars over the life of your home: file for your homestead exemption. As soon as that deed is recorded in your name, check your local county tax assessor's website. A homestead exemption is a legal provision that can reduce the amount of property tax you have to pay on your primary residence. The rules and amounts vary wildly by state and county, but it's essentially free money you're leaving on the table if you don't apply for it. It's one of the best financial perks of being a homeowner, so don't forget to claim it. And that's it. That's the entire journey. Let's just take a second and look back at how far you've come. You started with a dream, a vague idea of owning a place to call your own. You took the first terrifying step and checked your credit, facing the numbers head-on. You gathered your documents, pay stubs, tax returns, bank statements, and got a pre-approval, turning that dream into a tangible budget. You went to war in the housing market, searching, touring, and finally finding the one. You structured an offer, navigated the negotiations, and felt the thrill of going under contract. Then you entered the gauntlet of underwriting. You answered the calls, provided the extra paperwork, and explained that one weird deposit from 3 months ago. You held your breath through the appraisal and the inspection, clearing each hurdle. You secured your homeowner's insurance and got the final glorious clear to close. And you ended up in that conference room, signing your name until your hand cramped, and walking out with a set of keys and a whole new future. The U.S. mortgage process is long, It can be confusing, and at times it can feel invasive and overwhelming. But it's not magic, and it's not impossible. Just a process, a series of steps. And now you know every single one of them. You have the map. You understand the language. You know what to expect, what to watch out for, and how to prepare. This journey is about more than just interest rates and debt-to-income ratios. It's about building a foundation. It's about creating a space for your life to unfold, a place for memories to be made. It's about achieving a piece of the American dream that for so many feels out of reach. But it isn't. Not for you. Not anymore. You have the knowledge. You have the guide. The only thing left to do is take the first step.